Right, let's have a look at Bollinger Bands and what they are. So, really simple to begin with. So, what we've got to focus on first of all is the center of the band. Center of the Bollinger Band, which is a 20 moving average. So, that is a lagging moving average. So, whatever price action does, the moving average will follow. So, it's not leading at all. It's not leading in any way. It's 20 periods behind price action. And it basically moves with the price action. Now, you're 65% more likely to remain in the portion of the band that you're in. So when above it, you're 65% more likely to get a retest and a bounce from it than you are to break down. But because it's 65%, it's not the greatest odds. And so in the event that we do close below it, you look for a retest of it and then move back down. Again, a retest of it, move back down. 65% more likely to remain in the portion of the band that you're in while you're in it. So this is the bottom portion, rejected from it here, back down, rejected, and then broke, retested, up. Move back down, close below it. You can see the rejection here right in the center, bang, all the way down. Rejected here again, reclaimed it, retested it, up. So it's not perfect, but it's a good moving average to have. It's basically why it's the center of a Bollinger Band. It's, to me and to many, it's the most important moving average that you can have on your chart. And like any moving average, whichever direction it's pointing in is the direction of the trend. So when you get a strong trend, you will continue to move up and point up and generally trend up, which is why a weekly moving average, because the 20 weekly moving average is more important because it directs you in a much larger, more long-standing trend. Since we reclaimed it here, we retested it. What a great place to have bought Bitcoin in hindsight. The retest of the moving average after a bear market. Bear market, rejection, reclaim, retest, up and away. And I mean, like I say, on a trending move, which this is, the moving average is facing up, you've got a retest of it, you're 65% more likely to remain in that portion of the band. Before we actually reached a peak on this one, which the Bollinger Bands wouldn't have helped you with, but before you reached a peak, that would have yielded from the retest a 279% move over the space of a year. Now, things are slightly different in a consolidation, but yeah, after a long bear market, the first time that we broke out and retested that moving average yielded such a large result. So Bollinger Bands are good, and the 20 moving average on its own is good. Now, the other part of the Bollinger Band is based around volatility, which is the upper portion of the band here and the lower portion of the band. Now, these expand with price action and volatility. So as you can see, as the price moves up and the volume comes in and the volatility expands, so does the Bollinger Band. And what that does is it doesn't really give you so much an area of resistance, although you can use it like that. It shows you the potential for up and the potential for downside move if the volatility continues to be as crazy as it is. I mean, look at this on a weekly. If you were riding up this at $74,000 and the bottom of the Bollinger Band is all the way down here at 26. It seems unrealistic, completely unrealistic that could be visited, but I suppose it is to a large extent, but it's not entirely impossible. But the way to view the upper portion or the lower portion of the band is that you can be outside of the band and you're more likely to be sucked back in. So statistically, like I said, for the center of the band, you're more likely to get a support on it or a rejection below it when you're in that portion of the band, so 65% more likely to remain in that portion of the band. You're 95% more likely to be seeing price action take place within the Bollinger Bands themselves, so the upper and the lower. So any time that you see price action floating outside of a Bollinger Band, you're not guaranteed, but you're 95% more likely to be sucked back into the band at some point. So never, from a risk management perspective, never consider buying anything that's outside of a Bollinger Band, because, like I say, 95% of price action takes place within the bands themselves. So it's only a matter of time before it gets sucked back into the Bollinger Band, and possibly, hopefully, if you're looking to buy or go long, come back down to the 20 moving average, where that would be a more acceptable position to take. Again, it's all about risk to reward. Floating outside of a Bollinger Band, high risk. Moving back towards the center, low risk. And again, the same would apply for downside moves. You see this big wick here getting sucked back into the center of the range. 95% of price action takes place within the Bollinger Bands themselves, and you're 65% more likely to be rejected at the center of the band. So it's quite a simple strategy, simple Bollinger Band strategy. If there was to be only one indicator to overlay onto any chart, I would probably say the Bollinger Band's pretty much the only one that you would really want or need, because it might be slow and it might not be leading, but it gives you an idea of risk to reward with a simple moving average and some volatility expansion on the bands. Now, there is more to it than that, but that's the best way to try and manage any kind of trade based on a Bollinger Band. But when, like I say, because the outside portions of the band are expand and contract with volatility, when there's periods of low volatility, the bands contract. They get smaller. They're smaller. And when that happens, it's more likely that you're going to get an expanding move. Now, this was, excuse me, a bear market, and it was slow and drawn out, and with every high and every lower low and every lower high and every lower low, it got smaller and smaller and smaller until there was a period of a couple of months where price action more or less stayed static, getting rejected each time from the center of the Bollinger Band. And you can see that the bands had really started to pinch within a weekly. Obviously that's quite a large range, but compared to how it was previously, that's quite small. So it would appear, and again, in hindsight, everything's very clear, but it would appear that being below, you're more likely to remain below the Bollinger Band. Every time you move into it, you're more likely to get rejected from it. It happened over and over and over again. This is a bit of an anomaly here, but over and over and over and over again. And as the Bollinger Bands contract, you're looking for a more volatile move. Now, the odds would be in favor of a downside move here because you're below the Bollinger Band. So you've got two things going on here. You've got Bollinger Bands pinching, which suggests that with the contraction of those Bollinger Bands, a large move is likely to take place. But risk to reward would say that since you're below the 20 weekly or the 20 moving average, you're more likely to have that big move take place in a downside move. So again, hindsight is always very clear, but you can see how that has worked here. So big expansion, contraction, 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 below the 20, below the 20, below the 20, and then finally the last rejection took place here. The Bollinger Bands were tighter than they've been in over a year, and then that big move took place down. And only when we reclaimed it and retested it, again, did the odds flip to the bullish side. Odds flipped in your favour, and we went up from here. So broke out from the Bollinger Band, retested that centre of the Bollinger Band centre, that 20 moving average, and then powered on through. That, again, happened in this period over here. So, we were up, we were down, we were up. There's your retest. The retest took place around 8,000. We had another retest over here, and that led to this huge move. And again, recently after this bear market, rejection, 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 up, retest, up, up, and away. The things got a bit scary here, I have to say, but it still continued up. So that is the overview of a Bollinger Band. It happens on any time frame, whether it's a weekly, a daily, all the way down to a 15-minute, which is all still absolutely tradable, depending on what time frame you're trading on. The strategy remains the same. So hopefully that is useful to you, and I'll leave it with you there, and I'll add some more indicator videos solely for the purpose of a Patreon member. Right, thanks for watching. Take it easy.